Hello, welcome back to the channel. You are probably parking your idle cash in a liquid fund along with the fixed deposit for the emergency purpose or for short time period. Like say for example, if you have a goals for 6 months to 1 year, you are parking that cash either in the fixed deposit or liquid fund. Well, what if I told you that instead of liquid funds, there is a smarter tax efficient alternative? We are talking about arbitrage fund. You will learn what they are, how they work, and why they could be a better than your trusty liquid funds. And stick around because by the end you might just switch where you keep your emergency fund. So what are arbitrage funds? Arbitrage funds are type of mutual fund, but they are not like your regular equity or debt funds. Arbitrage funds aim to profit from price differences of the same stock in different markets. The fund manager buys a stock in the cash market and sells it simultaneously in the futures market at a higher price. The price gap is called the arbitrage spread, and that's where your return comes from. It's kind of like this. Imagine you brought an onion from your local market at rupees 20 per kg and found someone online who agreed to pay you 22 rupees per kg at the same time. So you lock in your rupees 2 profit instantly. Now, say for example, you do this for 20 to 30 items. That's what a arbitrage fund is doing for you. And no, you don't need to know futures or options. The fund manager handles it all under the hood. So how arbitrage fund work? Fund manager buys a stock in the cash segment of the market. Say Infosys rupees 1500 per stock. Simultaneously sells a future contract of the same stock in the future segment, say Infosys future at 1520. On expiry, the price of cash and futures converge. Both positions are squared off and the spread becomes your gain. So the fund isn't gambling on stock prices going up or down. It's playing the spread between the two markets and locking profits regardless of the direction which the stocks moves. Now here's the kicker. This strategy works best when the markets are volatile because spreads usually widen, giving high returns. You might ask that arbitrage funds are low risk or high risk. Arbitrage funds are technically equity funds, but they behave like a debt fund in terms of risk because the buying and selling happen simultaneously, locking in the profit upfront. That's a little directional exposure to the market. Think of them are almost risk free, though it's not completely. So if we compare that with pure equity funds give higher returns and it has high risk. Debt funds, they are moderate returns and they have moderate risk. Whereas arbitrage funds has low returns whereas it has low risk. They are not suitable for getting rich quick, but they are perfect for conservative investors or short-term parking. Now let's take two real-life examples of arbitrage funds. Number one is Nippon India Arbitrage Fund, where the 1 year return is 7.52%, whereas the 3 year return is 7.30%, and the total market cap is 14,000 crore. And the second is ICICI Prudential Equity Arbitrage Fund, where 1 year return is 7.64% and 3 year return is 7.29%, and the total market cap is 26,917 crore. Now compare these two liquid funds in the same time frame. They usually offer around 5.5 to 7% at best over 1 year. So arbitrage funds are neck to neck, sometimes even better, sometimes little less. But it comes with a major tax advantage. But we will get to that in a moment. So if we compare the arbitrage fund with the liquid funds, you will see that the arbitrage fund are the equity, whereas the liquid funds are debt. The risk is low in the arbitrage fund, whereas in liquid fund it's very low. The expected returns are around 5 to 7% in arbitrage fund, whereas in liquid fund is also 5 to 7%. Taxation. This is where the arbitrage fund gives more returns because the arbitrage fund have two types of taxation, that is short-term capital gain tax and long-term capital gain tax. Short-term capital gain tax, that means if we take out in less than 1 year, we have to give short-term capital gain tax as 20%. Whereas if we take out after 1 year, we have to give long-term capital gain tax as 12.5% above 1.25 lakhs. But in liquid fund, you will be taxed as per the tax slab. So the volatility of arbitrage fund is slight, whereas liquid fund is minimal. So arbitrage fund is ideal for parking money from 6 to 2 years. Whereas liquid fund is parking for few days to 1 year. Or debt fund. You can change the liquid fund to debt also. So everything will be similar. And so in short, if you are in 20 to 30% tax bracket, if you are a salaried and if you are in 20 to 30% tax bracket, arbitrage funds can offer best post-tax returns than the liquid or debt funds. Even if pre-tax returns are similar, you take home more with arbitrage due to the equity taxation. So why invest in the arbitrage over liquid funds? It has a better post-tax returns. Say if you are earning 6.5% in both arbitrage and liquid funds, and if you are in 30% tax slab, liquid fund you have to pay 30% tax. That means effective return will be 4.55%. So in arbitrage fund you have to pay 20% as short-term capital gain tax. So effective return will be 5.5% or little less. So you are losing around 1% just in taxes with the liquid funds or debt funds. Arbitrage funds are ideal for money you don't need right away. Say you need the money 6 months to 12 months. Okay, perfect use case are that is keeping it for emergency funds, short-term goals like school fees, rent or vacation, parking bonus or salary hike until you decide where to invest that money. Believe it or not, arbitrage funds perform better when the markets are volatile. Why? Because spreads between cash and futures widen. So while the rest of your portfolio panics, this one smiles and gives you good returns. So if we compare with the bank FD, it gives around 7%, 6%, 7.5%. Okay, but we have to pay 30% tax on that. Like if you are in that tax bracket. So the post tax will be 4.5 to 5%. Arbitrage fund at the same return will give you 20% tax, which is around 5.1% over. So we will get little better than the bank FD. So here's where people get it wrong. They see arbitrage funds labeled as equity and assume they are risky. Or they invest for only 15 to 20 days and get disappointed by exit loads and lower gains. You see, arbitrage funds need at least 1 month holding, preferably 3 to 6 months to make real difference. So don't treat them like your savings account. Treat them like a low risk tax efficient parking spot. So if you are a salaried individual, your company might give credit bonuses, reimbursement or annual incentives. So what you do with that money? You can keep it bank savings, which will give you 3.5%. You can get FD, which will give you 7.5%, but you will be taxed at your income tax. Okay. Liquid fund, better, but it's not that tax friendly. Instead, that money can be put it in the arbitrage fund. Okay, you can you can choose the direct fund plan and growth option for the max benefit. You have to keep it for 3+ months. Okay, you can enjoy the equity style taxation and debt style risk. It's the best of both worlds. The moment I realized this, I switched half of my emergency fund from liquid to arbitrage. Okay, so I am keeping 4 to 5 lakhs as my emergency funds. So in that 2.5 is in FD and the rest is in the arbitrage funds. Okay, why FD? You may ask why FD? I can move all my FD to the arbitrage fund, but I'm keeping that FD for the emergency purpose. Arbitrage fund, if say for example I need that money now, okay, the fund may give us the money after 2 to 3 days, but FD can liquidate anytime. So that's why if you are also planning to invest in the arbitrage fund, do not break all your FD. Okay, keep some cash, like keep some money in the FD, and after that move that extra money to the arbitrage fund and get that tax benefit. Thank you for watching. Please like, subscribe and share the video if you have liked it. Thank you.